to Startuprad.io, your podcast and YouTube blog covering the German startup scene with news, interviews, and live events.
Hello and welcome everybody. This is Joe from Startuprad.io, the authority on German, Swiss, and Austrian startups. Today we take you inside the 2025 coalition agreement between Germany's two biggest parties, the SPD, the party of soon-to-be former Chancellor Olaf Scholz and former Chancellor Gerhard Schröder, and the CDU, the party of Helmut Kohl, Angela Merkel, and soon-to-be Chancellor Friedrich Merz. This deal is shaping the next 4 years of startup, innovation, and venture policy. We focus on it to see growth impulses since Germany has recently been forecasted to have the third year without growth in a row. This has never happened since 1945. But here's the catch in the contract. Startup, venture capital, growth companies appear only once. Start minus up, German spelling of startup, is mentioned twice. The German word for founding, meaning Gründung, founding a company, appears 20 times, but not always in reference to entrepreneurship. For example, founding a family, founding of local initiatives, and so on. One should expect more in a 185-page document laying out the likely future policy for Germany. Meanwhile, innovation is mentioned 126 times. That says a lot. And many of these promises come with a critical footnote. They're subject to a Finanzierungsvorbehalt, wonderful German word, a funding reservation clause. In plain English, lots of good intentions, but only if the money shows up. So in this episode, we'll go deep how the coalition views innovation, what's missing for the startup scene, and why Germany risks falling behind unless it aligns with execution. Special note, a numerical target finally. I asked my assistant to make a pie chart of everything that's going on here in the 185 pages document, and actually gesellschaftlicher Zusammenhalt, social cohesion, Arbeit und Soziales, work and social dominate by far. Social cohesion makes up around 21% of the document, and work and social a little bit over 19%. Growth, innovation and wealth, Wachstum, Innovation und Wohlstand, which includes startups, account for just 13%. Digitization and media, crucial for the startup ecosystem, account only for 5%. Here's another structural insight worth noting. All startup relevant content only begins on page 139 of a 185-page document. Within the relevant chapter, there's a focus heavy on digitization in existing industries. Think Industry 4.0, top-tier academic research, and general infrastructure. Germany declares it wants to become the #1 digital growth company, but that ambition is buried deep after sections of industrial digitalization. Even crucial themes like cybersecurity, cloud, and big data are reduced to a single paragraph. When startups finally get their moment, the topics include startup networks, internationalization, the Gründerzeit proposal, more about that later, crowdfunding support, improved stock option models, and standardized founders' contracts. There's also the conceptual idea of Markt 2.0, Market 2.0, a potential new segment to encourage IPOs, but only mentioned in passing and comes without any structural or legal details. I'm sure many listeners still remember the Neuer Markt, the new market. Maybe the policymakers have learned. Let's give you a short recap about that. Launched 1996 by Deutsche Börse as a competitor of NASDAQ, listed at its peaks 300 companies, and drew massive hype here in Germany, especially from retail investors. With the dot-com bubble burst, the segment lost massively, many companies disappeared, and the segment was officially shut down in 2003, so it didn't survive the dot-com bubble burst. Note that there are partial different segments at Deutsche Börse right now, but since 2003, a real one-to-one comparison competitor of NASDAQ is missing. So what's missing? A talent strategy beyond requalification, no visas, no global talent attraction framework, and little to no detail on startup scaling mechanisms, a really crucial point here in Europe. A coalition of innovation or just a word? The SPD-CDU coalition agreement claims to prioritize innovation, and indeed innovation appears more than 100 times. But the real question is, what does the innovation actually mean? You'll find it linked to everything: climate, education, transportation, health tech, public administration, but you won't find a corresponding framework, timeline, or KPIs. The term is used as a strategic umbrella without a strategic spine. There's talk of innovation districts and a push to establish new regional clusters, but we've heard that before. The absence of targeted mechanisms like procurement reforms to favor new tech solutions or government-backed test beds for startups shows lack of operational muscle. Compare it to the 2021 coalition agreement, which had an explicit startup strategy. This 2021 called for regulatory sandboxes and even committed to better stock option taxation. That earlier document also helped catalyze the launch of Zukunftsfonds, a 10 billion vehicle to back growth stage funding in Germany. The government also stated that the now delayed WIN initiative channeling 12 billion euro into the startup scene until 2030. In contrast, the 2025 agreement gives us a wish list, not a strategy. For founders and innovators, this makes a big difference. Innovation talk is good, but innovation funding even better. Startups in the shadow. Is this a policy downgrade? Let's address the elephant in the room, the near invisibility of startups in this deal. Despite Germany's growing role as a European startup hub, especially in tech sectors like enterprise SaaS, climate tech, and industrial IoT, the term startup is not used frequently. Venture capital, just once. Growth companies, only one. That's it. And yet, during the pandemic, the startup BioNTech gave Germany's GDP a massive boost, up to 0.5% in 2021 alone, according to Reuters. Germany, the world's third largest economy at the time, benefited more from a single startup than from many traditional stimulus tools. Still, that kind of impact doesn't seem to have inspired great attention. The only tangible mention, a vague nod towards the potential introduction of a venture capital law, which, while potentially valuable, lacks substance, deadlines, or funding commitments. This omission stands in stark contrast to the initiatives in other EU countries. France's TB initiatives has mobilized over 30 billion for late-stage VC funding. Spain's Startup Law 2.0 includes tax reliefs, fast-track visa for tech talent, and simplified regulatory procedures. Portugal introduced co-investment vehicles and is actively targeting international founders. VC reactions. Several leading German VCs have expressed frustration. Some call it a step backwards. One went as far as to say Germany is becoming the garage of Europe, where startups are born, but scale elsewhere. Let's compare the coalition contract 2021 between SPD, the Green Party, and the FDP, and the 2025. 2021 had a startup strategy, expansion of high-tech Gründerfonds exists, stock option reforms, pension fund VC investments. 2025, no current extension of high-tech Gründerfond, no founder incentives, no stock option clarity, and no mention of exist at all. Finanzierungsvorbehalt, the real power player. Let's talk about a recurring red flag, Finanzierungsvorbehalt. It means subject to budget availability. In practice, it means maybe. Nearly every initiative, no matter how visionary, whether it's around quantum computing, green hydrogen, or AI clusters, comes with a budgetary disclaimer. This is a big issue. For startups and VCs, timing matters. Launching a product, fundraising, scaling international. These are all processes that depend on predictable timelines and stable policy environment. The presence of so many conditional clauses signals to founders and investors that the government is unsure of its own financial priorities. And In a time when countries like France and Denmark are pre-funding innovation programs, Germany's approach feels risky. The strategic implication: expect capital, especially international capital, to flow toward jurisdictions where the rules and resources are already locked in. Germany might have top universities and talent, but without committed follow-through, founders will increasingly look elsewhere. Europe moves ahead, Germany hangs back. Step back and zoom out across Europe. We're in a continental race to foster innovation economies. Governments aren't just encouraging startups, they're competing for them. France is actively scaling France 2030 with 54 billion committed to transforming the French economy through innovation. Spain has earmarked 4 billion for AI, data and entrepreneurship support through its next-gen EU deployment. The Netherlands has introduced sovereign tech funds focused on strategic autonomy, offering co-investments to deep tech startups. Germany, it's still thinking about its next steps. Despite being Europe's economic engine, it lacks the structural boldness that the move demands. This creates a startup migration risk. Berlin and Munich might continue birthing startups, but growth, talent, and capital could increasingly concentrate in other places. More critical, in an area where innovation is linked to sovereignty, Germany's absence from the startup fast lane could become a geopolitical blind spot. What founders and VCs should do now. So what now? What should you do if you're a founder, angel, or VC in the DACH region? Leverage EU funding. Don't wait for Berlin. Apply to the Horizon Europe, the EIC Accelerator, and the cross-border programs for InvestEU. Align with policy buzzwords. Frame your startup to fit in infrastructure innovation, energy, climate, health, AI, mobility. These get attention and potentially resources. Find funding diversity, cross-border syndicates, family office networks, European fund of funds. Don't wait for the German government to fix VC access. Look for city-level or Länder, meaning state funding. Municipalities like Berlin, Hamburg, or North Rhine-Westphalia often have faster-moving programs than the federal level. Get loud and organized. Join a founder coalition. Write op-eds. Post on LinkedIn. Governments do respond to coordinated pushback, and especially if it comes to high-performing ecosystems. VC tactic. Reduce exposure to startups heavily reliant on public funding in Germany. Look towards scalable sectors and diversify your follow-ons to regions with firmer startup policies. The lesson: plan around the coalition, not with it. Finally, an idea we love: Gründerzeit, paid time to found. Also, on page, 140, there's one proposal that genuinely caught our attention: Gründerzeit. It's the idea of offering paid leave, not unlike paternal leave, for individuals looking to found a company. The aim is to give aspiring entrepreneurs time and financial breathing room to develop their business ideas, validate the market, and build initial tracking before jumping into full-time founding mode. If implemented well, this could remove a key psychological and financial barrier to entrepreneurship, especially for people without existing capital or networks. It's a small mention with a big potential. Note, there's currently a way for unemployed people to get support to start a company, Gründerzuschuss, but it's minimal and only for 6 months, where first-time founders need much longer for the first fund to raise, if ever. Therefore, we are afraid the new program will just copy the old, insufficient program. Let's see if the government has a good surprise for us up their sleeves here. To sum it all up, innovation is everywhere. 126 mentions, but action is scarce. Startup, venture capital, growth companies just appear once, start minus up just twice. The only numeric startup related goal is buried again on page 140, grow new company foundations from 10,000 to 15,000 per year. Note, in 2024, Germany saw 120,000 plus companies founded overall, according to the status. Also, the German Startup Association tracked only slightly below 3,000 new startups founded in 2024. We're not sure what this refers to, but if it's startups and tech companies, count us in. Many initiatives are stalled behind vague financing clauses. The reform of stock options of the outgoing government was not to the liking of Germany's Startup Association. Some really promising ideas like Gründerzeit get a single paragraph without clear implementation plans. Germany has a world-class technical talent, strong institutions, and a respected academic base. But until startup policy reflects that foundation with real capital, real strategy, and real urgency, it risks watching the future happen elsewhere. If this episode resonated, please subscribe wherever you get your podcast. Share this with a founder, policymaker, or investor who needs to know what's at stake, and visit Startuprad.io for the full write-up, pie charts, and expert analysis. Until next time, stay sharp, stay bold, and keep building smart. This has been Joe from Startuprad.io, your insider pass to what matters in DACH, tech, venture, and startups.
That's all, folks. Find more news, streams, events, and interviews at www.startuprad.io. Remember, sharing is caring.